I'm not getting rid of my gold and silver, because gold and silver were the best performing commodities assets in the 70s. In the 40s, of course, gold and silver were, well, gold was illegal in the US and in most other countries as well, or gold was money and the price of gold or was fixed to the currencies. Silver was really hard to get, probably because they needed it for the war. What I'm trying to say, it wasn't traded as much as now. Yeah, but that's why I'm not getting rid of my gold and silver, because I think the waves, inflationary waves, are just starting. We had the first one. We're going to get a second at least. We might even get a third. And then things are going to get really rough, and you will want to have some protection.
The latest economic data has surprised many, with January's price growth clocking in at an annual rate of 3.1%. Beating economists' forecasts of 2.9%. It's a noticeable pullback compared to December's 3.4% consumer price index. Amidst this backdrop, some, like Mario Innecco, are doubling down on their investments in gold and silver. Their rationale? The historical performance of these metals during periods of inflation, like the economically tumultuous 1970s and 1940s, serves as a robust reference point. This unwavering trust in precious metals is not new. For decades, gold and silver have been seen as hedges against inflation and stable stores of value, particularly when currencies lose their shine. When inflation rises, demand for tangible assets like gold often surges, a trend driven by diminishing faith in fiat money. A fascinating tidbit from history underlines this point. In the 1970s, while gold posted a staggering 1,800% return, silver outperformed its more glamorous cousin. The collapse of the Bretton Woods system in 1971, freeing the US dollar from its fixed exchange rate with gold, and the subsequent stagflation crisis, marked by high inflation, tepid growth, and stubborn unemployment, created an ideal breeding ground for gold's ascent. This period climaxed with gold hitting a record high of nearly $665 in January 1980. Post-World War II, the U.S. experienced an economic roller coaster. Inflation dipped briefly, only to surge as post-war production shortages sent prices soaring. This erratic inflation pattern persisted for several years and was influenced by various economic variables. Join us as we explore the insights shared by Mario Innecco. Stay updated by subscribing to our channel and activating notifications. Thank you.
Yes, of course, you're going to hear Jeremy Hunt, Janet Yellen, Jay Powell, Andrew Bailey, all saying that they can stop inflation, but they won't be able to. So let's quickly go through these cycles then. Let's bring them up. So, and again, I have to thank Rafi for this, because I didn't realize that there was an inflation wave cycle during the 1940s, which makes sense, of course, because that was during World War II. So as you can see here, there's the inflation cycle, and this is taken from the Bureau of Labor Statistics. And like Rafi said in this video, they've tinkered, of course, with the inflation data, or CPI. It's probably a lot lower now than it should really be, but we want to see the cycles. It doesn't matter what the number is. So World War I started for the US, of course, in late 1941. So you can see inflation picked up there. Going into 1942, it seems like it was already picking up prior to the breakout, but it topped around 12% or so, and then it came down towards the end of the war. And then it looks like they put price controls there, like Rafi said in his video. It was pretty flat. But then when people came back from the war and the private, free economy kicked off, so to speak, there's a lot of shortages. A lot of the industrial base had been transferred or converted into creating war materials, right? Not consumer goods. So prices went up again. There's a lot of currency flowing around as well to finance the war. And we got up to almost 20%, and then it came down. And after that, there might have been a little bit of inflation, but it was pretty, how can I say, smooth sailing up until, of course, the late or mid 60s to the early 80s. And back then we had three waves. In the 40s, we had 2.
The recent meeting of the Federal Reserve displayed a notable concern among officials regarding the persistently high inflation level. Amidst this, Mario postulates that we might be in the early throes of an inflationary era, foreseeing potentially 2 more phases of inflation yet to come. The recently released minutes from the policy meeting indicated that Fed staff economists have recognized the heightened uncertainty around the baseline projection. However, this uncertainty has notably decreased over the past year, suggesting that there might be a clearer trajectory ahead. Christopher Waller, a distinguished member of the Fed's Board of Governors, emphasized in his remarks titled, "What's the Rush?" that any steps taken to alleviate inflation should be cautious. He urged a patient approach, highlighting the importance of verifying the sustained progress against inflation observed in the latter half of 2023 before making any significant policy shifts, such as cutting interest rates. Mario poses a significant question, echoing many's concerns. Can policymakers curb inflation without inflicting harm on the economy? Let's get back to the interview.
In the 60s, 70s, and early 80s, we had these inflation waves. And one of the reasons why, in my opinion, you can't stop these is that prices are the consequence of inflation or creation of currency and credit. And unless you want to really destroy the economy, that currency and credit is going to stay in the system, and it is going to reflect itself as rising prices. So we can see here the first wave got inflation up to 6% or CPI. Then it drifted down into the early 70s there, probably around 72, 73, down to almost 2%. And then we had the second big wave, pretty big wave. We got up to 12% in 1975 or thereabouts. And then we had another wave that came down. And then from 1977 onwards, we had the third big wave, and we got up to above 14%. And then after that, the central banks, of course, were able to tame inflation. They didn't get rid of inflation. We still had 2, 3, 4%. And even 2% CPI is bad because it halves the value of the currency over 40 years. So now we come to the present day, and we're just starting, in my opinion, here. Either we're going to have 2 waves like in the 40s or 3. So we've ended the first wave here, and it started from March 2020. And we know what happened then. And we got up to 9%. And I would say this was probably more like 15% or 12% because they fudged so much the CPI. They've done it, since the 90s. And you can go to shadowstats.com, and John Williams talks about that. So yeah, we had this first wave in 2020 to maybe early 2023 or thereabouts, and it's come down now. And the question here is whether there's just going to be one wave or 2 or 3. I think there will be 2, at least 2. Of course, we're going to be told no that by central bankers and politicians that they've got it under control, getting rid of my gold and silver, because gold and silver were the best performing commodities assets in the 70s. In the 40s, of course, gold and silver gold was illegal in the US and in most other countries as well, or gold was money, and the price of gold was fixed to the currencies. Silver was really hard to get, probably, because they needed it for the war. What I'm trying to say, it wasn't traded as much as now. Yeah, but that's why I'm not getting rid of my gold and silver, because I think the waves, inflationary waves, are just starting. We had the first one. We're going to get a second at least. We might even get a third. And then things are going to get really rough. And you will want to have some protection. Gold and silver are not for trading.
Many economists had anticipated that the Federal Reserve would undertake its inaugural rate cut sometime between May and June. However, Christopher Waller's recent comments could influence or alter these expectations. The Federal Reserve's December forecast had projected 3/4-point reductions in its benchmark rate over the year. The benchmark rate, which experienced swift increases throughout 2022 and 2023, currently stands at approximately 5.4%, marking a significant 22-year peak. That's all from us. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.